Welcome to the world of accounting, often seen as a complex and dry subject. But in reality, it's a critical life skill that everyone, not just businesses, needs to understand. So, what exactly is accounting? Accounting is the process of recording, summarizing, and analyzing financial transactions. But it's not just for companies and organizations. Accounting is a tool that helps each of us make sense of our financial decisions. Why accounting matters to you? You might be thinking, I'm not a business, so why should I care about accounting? Here's the answer. Accounting is for everyone. Whether you're managing your monthly budget, saving for a future goal, or planning to invest, accounting principles guide every financial decision you make. Imagine not knowing where your money goes each month. That's financial chaos. But with basic accounting skills, you can take control of your personal finances and avoid unnecessary stress. Core concepts of accounting. Let's break down four key concepts that form the foundation of accounting and personal finance. First, income. This is any money that you earn, whether from a job, investments, or other sources. Two, expenses. The money you spend, like on rent, food, or entertainment. Then there's assets, things you own that have value, such as savings account or a vehicle. And finally, liabilities. These are financial obligations like student loans or credit card debit. Understanding the relationship between these four concepts is key to making smarter financial decisions. Real life application of accounting. Now that we've covered the basics, let's see how you can start applying these concepts in real life. Start by tracking your income and expenses. Are you spending more than you earn? If so, you're dipping into your savings, or worse, taking on debt. Next, set financial goals and create a simple budget. Budgeting is one of the most effective tools in personal accounting. It helps you prioritize your assets, like building an emergency fund, while keeping liabilities under control. Accounting in your future. Accounting isn't just useful for managing your personal finances. No matter what career path you choose, whether it's business, engineering, the arts, or science, understanding accounting will give you an edge. Every field involves financial decision making, and being comfortable with accounting will make you more effective at managing resources, analyzing costs, and contributing to financial health. In fact, employers in all sectors appreciate candidates who understand the financial side of their role. So, mastering accounting now could even boost your career prospects. In closing, so whether you're managing your own money or contributing to the success of any organization, accounting is a skill that will serve you for life. Start small, track your spending, understand your assets and liabilities, and build a budget. Over time, you'll see how accounting helps you make better decisions and take control of your financial future. Remember, accounting isn't just about numbers, it's about taking control of one's life, one financial decision at a time. Basics of personal and business accounting. Hi, everyone, and welcome to today's session on basics of personal and business accounting, a key part of our financial literacy course. Whether you're managing your personal finances or running a business, understanding basic accounting can make all the difference in making sound financial decisions. So let's dive into the world of accounting, personal accounting. First, let's talk about personal accounting. Personal accounting is essentially about tracking your own money, how much you earn, how much you spend, and how and what you own and owe. It helps you manage your finances better, avoid unnecessary debt, and save for the future. At a personal level, accounting boils down to three key components. By keeping a record of these, you can create a simple budget and ensure your income covers your expenses while also saving for future goals. Now let's shift gears to business accounting. While personal accounting is about tracking individual finances, business accounting deals with the financial health of a company. It's a bit more complex but follows the same basic principles. In business, accounting helps keep track of the money flowing in and out. There are two main types of accounting systems in businesses. One, income. This includes all the money you receive, such as salary, interest from savings, or freelance work. And two, expenses. This covers everything you spend: rent, groceries, travel, entertainment, etc. Tracking your expenses is crucial to ensure you don't spend more than you earn. Assets and liabilities. Assets are things you own that have value, like a house, a car, or even savings in a bank account. Liabilities are what you owe, like student loans, credit card debt, or any other form of borrowing. Now let's shift gears to business accounting. While personal accounting is about tracking individual finances, business accounting deals with the financial health of a company. It's a bit more complex but follows the same basic principles. In business, accounting helps keep track of the money flowing in and out. There are two main types of accounting systems businesses use. One, cash accounting. This method records transactions when money actually changes hands, when you receive payment, or when you pay a bill. It's simple and works well for small businesses. Accrual accounting. In this system, revenue and expenses are recorded when they are earned or incurred, regardless of when the money is received or paid. Larger businesses use this to get a more accurate picture of their financial position. There are three key financial statements that businesses use to understand their financial health. Number one, income statement, also known as profit and loss statement. This shows the revenue, expenses, and profits or losses of a business over a specific period. It tells you if the business is making money or losing it. Number two, balance sheet. This provides a snapshot of the business's financial position at a given moment. It lists all the assets the business owns and the liabilities it owes. The difference between assets and liabilities gives you the company's equity. Number three, cash flow statement. This tracks the movement of cash in and out of the business. It shows if the company has enough cash to cover its expenses. The main difference between personal and business accounting lies in their purpose. Personal accounting helps you to manage your day to day finances and save for personal goals. Business accounting, on the other hand, ensures that a company remains profitable and financially stable over time. In both personal and business accounting, keeping accurate records is the foundation. For individuals, this could mean using a simple budget app or a spreadsheet. For businesses, accounting software like Tally or QuickBooks is often used to manage finances and generate reports. By understanding these basics, you're setting yourself up for success, whether it's managing your own money or running a business in the future. Accounting might sound complicated at first, but once you break it down, it's just a way to keep track of money, whether it's yours or your business's. Thanks for joining me today and encourage you to start practicing these basic concepts in your own life. See you in the next session. Stay tuned for more lessons on managing your finances better, one step at a time. Reading banking and credit card statements. Welcome to this short but essential video on reading banking and credit card statements. Understanding these documents is a crucial step in managing your finances effectively. Whether you're tracking your savings or monitoring credit card expenses, knowing how to read these statements can make all the difference. Your banking statement typically contains 1. Account summary. This section gives you an overview, including your opening balance, closing balance, and available balance. Number two, transaction details. Every deposit, withdrawal, and transfer during the period is listed here, including the date, description, and amount. Number three, fees and charges. If you've been charged any fees, such as ATM withdrawal fees or account maintenance fees, you'll find them here. Pay attention to transaction details. Ensure that each listed transaction is something you recognize. Fraudulent charges, though rare, can sometimes slip in. Always cross check your expenses with your records. Pay attention to transaction details. Ensure that each listed transaction is something you recognize. Fraudulent charges, though rare, can sometimes slip in. Always cross check your expenses with your records. Now let's move to the credit card statement, which can be a bit more complex. It shows your credit card usage and payments for a specific billing period. Here's what to focus on. Number one, statement date. The date the statement was generated. It usually marks the end of the billing cycle. 2. Due date. This is the deadline for your paying your bill to avoid late fees. 3. Total balance. The total amount you owe, including any previous balances and new purchases. 4. Minimum payment due. The smallest amount you can pay to keep your account in good standing. However, it's better to pay more than the minimum to avoid accumulating interest. 5. Interest rate. If you don't pay off your total balance, this is the rate at which interest will be charged on the remaining balance. Always strive to pay your full balance before the due date. Paying only the minimum can lead to hefty interest charges, causing your debt to grow quickly. Understanding transactions and fees. Similar to bank statements, credit card statements list your transactions, every purchase, payment, and fee. Check these carefully to ensure they match your actual spending. You'll also find fees and charges in your statement. These may include late payment fees, cash advance fees, or over limit fees. Avoid these by staying on top of your payments and knowing your credit limit. Tips for effective statement management. Here are a few tips for managing your statements effectively. Set up alerts through your bank or credit card provider to receive notifications for each transaction. 2. Review statements monthly. Don't wait till something goes wrong. 3. Keep track of due dates. Use reminders on your phone or computer. Number 4. Download and save your statements for future reference. This can help in budgeting and tracking long-term financial trends. Understanding your banking and credit card statements puts you in control of your finances. It's a small but vital step toward financial literacy and ultimately financial independence. So take a few minutes every month to review these documents. It'll pay off in the long run. Thank you for watching. In the next video, we'll explore how to set up a simple budget using the information from these statements. Reading company financial statements. Welcome to this video on reading company financial statements, an essential skill that helps you understand the financial health of a company. Even if you don't plan to major in finance, this skill is crucial for managing your personal investments like stocks and mutual funds. So let's break it down. What are financial statements? Every publicly listed company prepares and publishes financial statements. These are detailed reports that give investors and stakeholders insights into a company performance. There are three main financial statements you should focus on. One, income statement, also known as the profit and loss statement. Two, the balance sheet, a snapshot of the company's assets and liabilities. Three, cash flow statement, tracking the cash flow flowing in and out of the company. Why should you care? Even if finance isn't your chosen field of study, understanding these documents is vital for your personal financial literacy. When you invest in a company, whether through stocks or mutual funds, you're essentially putting your money into that business. Knowing how to read financial statements helps you make informed decisions about where to invest and whether a company is financially healthy. This knowledge will empower you to better understand whether the company is growing, profitable, or struggling, making you a more competent and responsible investor. Profit and loss statement. Let's start with the income statement. This statement answers a simple question: is the company making money? Key sections of the income statement include revenue, how much the company earned; expenses, what the company spent to earn that revenue; net profit or loss, what's left after expenses are subtracted from revenue. If a company consistently shows a net profit, that's a good sign. But if it's regularly operating at a loss, you might want to reconsider investing in it. Balance sheet, financial health snapshot. Next, we have the balance sheet. Think of this as the company's report card at a specific point in time. The balance sheet shows assets, what the company owns, like cash, inventory, or property; liabilities, what the company owes, such as loans and debts; equity, the owner's stake in the company, which is calculated as assets minus liability. For an investor, a strong balance sheet means the company has more assets than liabilities. Too many liabilities? This could spell trouble. Cash flow statement, money in and out. Finally, we come to the cash flow statement. It tracks how cash moves in and out of the company over a period of time. It has three key parts: operating activities, cash generated from the company's core business; investing activities, cash spent on things like equipment or investments; and financing activities, cash from borrowing or issuing shares. Why is this important? Even if a company is profitable on paper, poor cash flow can lead to problems paying bills or funding future growth. Strong positive cash flow means the company is financially healthy. How do these statements work together? Each of these statements tells part of the company's financial story, but together they give you a full picture. The income statement shows profitability. The balance sheet reveals the company's overall financial position. The cash flow statement tells you if the company has enough cash to keep operating. Why it matters to you. Now that you understand the basics of financial statements, remember, even if you don't plan to major in finance, being able to read these documents is essential. Whether you're investing in stocks or mutual funds, understanding a company's financial statements can help you make informed decisions and grow your wealth responsibly. Thank you for watching. Keep learning and growing your financial knowledge. Financial literacy course, financial statements, empowering you for smart investments.